Hi, and welcome to Chapter 3. I'm Shri Bergeron, and this chapter is going to build off of Chapter 2. So we've already learned what job order cost system is. So a job order cost system means that we're going to accumulate costs to find out how much a particular job costs us. So if we're making guitars, we're going to put direct materials, direct labor, and then we'll apply some factory overhead, and we can find out how much each guitar costs us. So that's what we mean by job order costing. So now we're going to see, how do accountants actually make this happen? What do we put into our records to find out how much it costs? So accountants do this by making journal entries, and we're going to be making our journal entries straight into the accounting equation so that we can not focus on the debits and credits, but instead focus on what is happening to the accounts, because that is the key to understanding what is happening on our financial statements. So if we make our journal entries into the accounting equation, we can see our ending balances, and then we can see where those flow on the financial statements so that we can better read financial statements. All right, so let's first talk about our three categories of inventory. We know that inventory is an asset, and it is something that a company sells to make a profit. Well, if we're in a manufacturing business, then we actually manufacture our inventory. We make our inventory. And so that means that we're going to have different categories of inventory to show where it is in process. So the first one is here. It's called raw materials. And this is any materials that we buy that are going to go into our finished inventory, but right now we haven't started working on them. So just lumber or glue, anything that we have in our warehouse that we haven't started working on. Once we start working on it, we move it out of raw materials and into work in process. So it's the same items that we had in raw materials, but in the process, we are now working on them. That is why it is called work in process. And when I say we move it, it means that I make a journal entry to take the money out of the raw materials account and put it into the work in process account. And then once we finish it and we complete it and it's ready for sale, then it moves into finished goods. So I'll take it out of work in process and put it into finished goods. And so when we add up all of our costs associated with manufacturing, it will be called our cost of goods manufactured. So this is just a subtotal, and it is made up of direct materials, direct labor, and factory overhead, and any beginning or ending work in process that we had. So these three items are categories of inventory, and this is a subtotal of cost of goods manufactured. So let's look at it like this. Here we have our product cost: raw materials purchased, direct labor, and manufacturing overhead. Those are the three costs that go into it. And so raw materials will show up on the balance sheet as an asset called raw materials inventory, but direct labor goes into work in process. We don't actually have an account called direct labor. We're going to use an account called work in process. And in fact, anything direct will go straight to work in process. If it's not direct, then we can't put it to work in process right away, because work in process actually is associated with a particular job. So like work in process guitar number 1. So if it's direct, we can go ahead and assign it there. But if it's indirect, we have to hold it in manufacturing overhead first, and then eventually allocate it to work in process. We'll just assign some of it to a job. So direct labor goes straight to work in process, and manufacturing overhead will go to work in process once we allocate it to it. And then all of that will flow to finished goods when we're ready. And then after we sell it, we'll take it out of finished goods and we'll finally expense it. And the expense that we put it into is called cost of goods sold. That is typically the biggest expense of a company, because it is the cost that it took to make what it is that they're selling. If you think about a merchandising business like Target, their biggest cost is their cost of goods sold. It's the same for a manufacturing company. That is the most substantial cost usually, is how much it costs them to make what it is that they're selling. Okay, so all of these were product costs, and that's why they get assigned to inventory until they're sold. Once they're sold, they're moved to the expense called cost of goods sold. All right. Period costs are everything that happened outside the plant, and they go straight to the income statement. They are going to be expensed in the period that they happened. These were not expensed. They were added to an asset until they were sold. These are expensed when they happen. We call that when they were incurred. All right, we're going to illustrate this by being the accountant for Ruger's Corporation. So it tells us that we are doing the month of April. They are a producer of gold and silver commemorative medallions, and they worked on only 2 jobs in April. Job A, a special minting of 1,000 gold medallions commemorating the invention of motion pictures, was started March and completed in April. As of March 31st, Job A had been assigned $30,000 in manufacturing costs, which corresponds with Ruger's work in process balance on April 1, $30,000. So we have a beginning work in process, April 1 of $30,000. For Job B, an order for 10,000 silver medallions commemorating the fall of the Berlin Wall was started in April and was incomplete at the end of the month. Okay, so now let's see what we do and how we're going to account for it. So first, they're going to purchase some raw materials, and it says that they already had $7,000 in raw materials, and during the month they purchased an additional $60,000 in raw materials. So raw materials is an inventory account, which means that it's an asset. And you can learn your debits and credits, and if you did, that would tell you that an asset goes up with a debit, so that's why we put it in on the left, and accounts payable goes up with the credit, because that's its normal balance. But don't worry about that. Instead, I want you to look at how it looks in the accounting equation and how to make it go up and down here. But I'm telling you now that we are increasing raw materials and increasing accounts payable for this transaction. All right, so we had 7,000 as a beginning balance, and we just add 60 more. So here's our accounting equation, and we're going to have assets are generally, we're probably not going to use cash in this particular example, but I'll put it there, cash, and then we've got our inventory account. So we have raw materials, we have work in process, we have finished goods, and until we allocate it out, we'll even have some manufacturing overhead. We may have some more later, so I'll add spots as I need to. All right, and then our liability is called accounts payable. That's things that we owe. So these are all things that we own that will benefit us for longer than a month. And these are things that we owe. And then equity is made up of capital, so any kind of owner investments, minus dividends, so anytime we distribute money to the shareholders, plus sales, minus expenses. So on the equity side, you really have to look and see, is it making it go up or down? Capital and sales make equity go up. Dividends and expenses make it go down. Okay, so let's go back to our raw materials. It said that we started off with a balance. All right, so I need a balance here of $7,000. And to make myself stay in balance, I'll assume that that was also on account. And then it says that we purchased more. So whenever we purchase it, it goes up because I now got more, received more raw materials. And I agreed to pay them on account. So that's my first journal entry. I bought raw materials on account. So let's just describe that transaction. Purchased $60,000 of raw materials on account. So the key here is to understand that your raw materials account went up and your liability went up as a result of this transaction. Let's look at the next transaction. During April, material requisition forms were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. So in other words, we are going to take $52,000 out of raw materials and start to use it. These raw materials included $50,000 of direct and $2,000 of indirect materials. So anything direct can be assigned straight to a job. And when it can be assigned straight to a job, we call that work in process. If we can't assign it to a job because it's indirect, we'll hold it in manufacturing overhead until we're ready to allocate it to the job. So that's why 50,000 of this will go to work in process, 2,000 of it will go to manufacturing overhead. So these are all asset accounts, and all assets actually go up with a debit. This is why we're debiting these, because they go up. And if they go up with a debit, assets must go down with the credit. So we're taking it out of raw materials, so we're going to credit it out of or subtract it from here. But again, I don't want to focus on debits and credits, so we're going to go focus on what it looks like in the accounting equation. All right, so that transaction would say something like requisitioned raw materials to production, and then it said direct materials, and it told us that it was 50,000, and indirect materials were 2,000. Okay, so again, we are taking it out of raw materials because we're requisitioning it out of our storeroom. So we're going to subtract 52,000 there, and we are going to put the direct into work in process because we can assign that to a job. So we're going to add 50 there. And then the ones that we can't assign to a job, we'll hold off the indirect into manufacturing overhead. So we'll add $2,000 there. So if I look at my accounting equation here, I'm still in balance because everything to the left, if I net it all together, look down here, equals 0. I'm going to fix that to where you can look down there with me. Hang on. All right, so I'll highlight all my assets. I look down there and it's 0. And of course, in this particular transaction, my liabilities plus owner's equity is also 0. So I am still in balance on that one. All right, so then I would get a new balance here by netting those numbers together. And I would make sure that I'm still in balance. Add up my assets and they equal 67,000. All of those are 0, that's why they came up with the value. And it equals 67,000 there. So let's look at the next transaction. Now we're talking about labor cost. So here we're thinking about direct labor and indirect labor. So in April, employee time tickets, which that's how we find the hourly summaries of each employee's activities, include $60,000 recorded for direct labor and $15,000 for indirect labor. The following entry summarizes these costs. All right, so everything direct, we know, can be assigned to a job, so it goes to work in process. Everything indirect has to wait inside of manufacturing overhead. And then all together, we'll agree to pay our employees, and so we'll put it into a liability, which is where we're promising to pay them. So salary and wages payable. All right, so this would look something like this. Recorded $60,000 of direct labor. That should have an extra 0 on it. Of direct labor. And $15,000 of indirect labor. And if it doesn't tell you otherwise, you can assume that you recorded it on account, which means salaries and payable. All right, so we actually need a new liability here. So I'm going to add a new liability here. And we'll call it salaries and wages payable. Okay, so the 60,000 of direct, where do we put everything direct? Because we can apply it to a particular job, it can go straight to work in process. So I'm going to put $60,000 to work in process. It's an increase. So I put it in as a positive. And then everything indirect goes to manufacturing overhead. So I put in $15,000 here. And I'm going to agree to pay it later, which means my liability increases. So my liability will go up by 60 plus 15, so that's 75,000. But in Excel, I want to use formulas whenever possible. So I'll say D9 plus F9, and I'll get 75,000. I added my assets. They equal 75,000. I added my liabilities and my owner's equity. They also equal 75,000, so I'm in balance. So I can come and get a new balance now of everything balance plus the new thing that just happened. And then do that all the way across. The dashes just mean 0. I'll make sure that I'm in balance, make sure I haven't messed up anything. 142, 142, so I'm in balance. All right, let's look at letter D. All right, recording actual manufacturing overhead. So now we're going to have some more indirect costs. That's why they said it was manufacturing overhead. So we're going to have utilities of $21,000, rent on factory equipment of $16,000, and miscellaneous factory overhead costs of $3,000. So all of those are inside the factory, but they are indirect. So they will all go to manufacturing overhead. So we'll add those three costs together, put it to manufacturing overhead, and we're just going to assume that we haven't paid for it yet, so we'll put it to accounts payable. The transaction would be worded something like this. Incurred $21,000 of utilities, $16,000 for rent on factory equipment, and $3,000 for miscellaneous factory overhead costs. So again, we know that all of those are indirect. Everything indirect goes to manufacturing overhead, so we would just add those together. So I'll say equals, and then I'll type in 21,000 plus 16,000 plus 3,000, and then I'll press enter. And I see that that's 40,000, and I have said that I'm going to do that on account, so I'll increase my liability, $40,000. I'll get new balances, make sure that I'm still in balance everywhere, and I'll keep going. Now every time we did manufacturing overhead, I kept saying we're just holding it there until we can apply it to the job. So here's where we're going to learn how to apply it to the job. We're going to use a predetermined manufacturing overhead rate, and then we will apply it based on an actual base. So it says that assume that Ruger's predetermined rate is $6 per machine hour. So they already computed that for us. And if you're curious how, they simply did an estimated manufacturing overhead rate divided by an estimated base, and they got $6. So that's what they're going to use. $6 is the rate. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B for a total of 15,000 machine hours. So we use the rate times the actual base, and their base is machine hours. So we're going to say 6 times $15,000, and that means that we are going to apply $90,000. We're going to take it out of manufacturing overhead and assign it to a job. So we're going to take it out of manufacturing overhead and put it into work in process for $90,000. So here's what that would look like. We would say that we applied $90,000 of manufacturing overhead to work in process. So we're going to take $90,000 out of manufacturing overhead, so we'll subtract it, and we're going to put it into work in process. So we've just moved it out of a holding asset and put it to the particular job right here. We'll get our new balances, and we'll see that we're still in balance by adding across and getting 182 and adding across and getting 182. So notice that so far we have not put anything to an expense, and that's because everything that we've incurred so far has been inside the plant. And everything inside the plant goes to an inventory account until we sell it. But we will have to account for these other non-manufacturing costs. So, for example, we'll have some salary expense for people who are working in marketing, selling, or administrative capacity. We may have some advertising expense, etc. So let's do these examples. Ruger Corporation incurred $30,000 in selling administrative salary costs during April. So because it says selling administrative, I can see that I'm outside the plant. So it's time to use an expense, and I'll call it salary expense. Here we have depreciation on office equipment. Because it says office, I can see that I'm outside the plant, so I'm going to use depreciation expense and accumulated depreciation. And then advertising, which is a selling expense, is outside the plant. And other administrative expenses are going to total $8,000, so I'll have advertising and other selling administrative expenses. and I'll put that on account. So let's go to the accounting equation and see what this would look like. All right, number 6 would be something like incurred $30,000 in selling and administrative salary costs. And if it doesn't say, we'll assume that that was on account. So we're going to make our expense, which we'll call it right here, salary expense. It's an equity account. We're going to increase our expense, but when we look at it in the accounting equation, we have to show what does it do to equity. Well, an expense makes equity go down, so we're going to subtract it to show that that had a negative impact on our stockholders' equity. So that amount was $30,000, and our liability for salary and wages payable goes up because we owe them the money, $30,000. So that gives us a net zero on the liabilities plus owner's equity side. So I'll just get my new balance here, and then I'll look at number 7. So number 7 says depreciation on office equipment. So depreciation on office equipment is $7,000. Okay, so office tells me that it is a period cost, which means that we go ahead and hit an expense. So we're going to call it depreciation expense. And again, it makes our equity go down, so we'll put it in as a negative. So it's negative $7,000. And then the other side of that is accumulated depreciation. So we need a couple more accounts over here. We need 2 more accounts just to make this make some sense to you. So we have something called equipment, which we would need a number in there, but I don't have a number. And that's okay, I'm just going to put it because I wanted to tell you that essentially what we're doing is reducing the value of equipment through depreciation. Kind of like if you drive a new car off the lot, it depreciates right away. That means your asset is not worth as much as it was when you first bought it. But we don't actually put it to that asset. We have a contra account, so we put it there instead, and we look at these 2 accounts together. So that has a negative impact on your equipment. So it is going to make your equipment go down by the $7,000. So really, if you want to know how much your equipment is worth, you need to look at both of these 2 count together. Of course, I don't have anything in my equipment account because this is just an example exercise, but I just wanted you to see that it goes next to equipment, and it's known as a contra asset. All right, so I'm going to go ahead and merge and center these cells so that you can see that all of these are under the asset category. This is just called a contra asset, but it goes under the asset category. All right, let's make sure that we're still in balance and keep going. I add up all my assets, and I get 175. I add up all my liabilities plus owner's equity or stockholders' equity, and I get 175. All right, number 8 says that we have some advertising and other selling expenses. So we'll say incurred advertising expense of $42,000 and other selling and admin costs of $8,000. All right, so we're going to have some more expenses added because those are period costs. So I'll add my advertising expense right here, and I'll add my selling and admin expense right there. All right, so I have $42,000 of advertising, and I have $8,000 of that. So altogether, I've incurred a new liability of 42 plus 8. So I'll put in the 50,000 right here. Not under salaries and wages, under accounts payable. And that needs to go up by 42,000 plus 8,000, which is 50,000. But as I said, I like to put in the formula so that I can see a history of how I got the numbers. And so my assets are my assets for this transaction are 0, and my liabilities plus owner's equity also net to 0. So I'm in balance for that. I'll get a new balance for balances. And just make sure that everything worked right and I'm in balance. So I've got 175 on that side, 175 on that side. All right. Next, we're going to account for finishing a job. So job A was completed during April and job B was incomplete at the end of the month. So we need to transfer the cost of job A out of in process and into finished goods since we've completed it. So we're going to move it out of work in process and into finished goods. All right, so this will be number 9, and it will say something like completed, let's see how much it was again, $158,000 for job B. So that means that we're going to transfer it out of work in process. So we're going to take it out of work in process, 158,000 goes down, and put it into finished goods. And we're still in balance because that nets to nothing. So we'll get our new balance across. We're finally ready to make some money. So we will assume that 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for total sales revenue of $225. Because 1,000 units were produced and the total cost of the job from the job sheet was $158, we can figure out that the unit product cost was $158. So all we say is that the total costs divided by the units produced tell us how much it costs us per unit. So that's how we'll figure out the cost of goods sold in the finished goods part. So we'll just say 158 times the number that we sold, which is 750. So the unit product cost 158 times the number that we sold, 750. That gives you the amount that you're going to take out of finished goods and finally expense and cost of goods sold. Now the amount of sales is how much your customers gave you for this, and it tells you that you sold them for $225. So that's the amount of sales. So you need both of these entries to account for a sale. This part accounts for the sales, and this part accounts for the movement of inventory. That is, we no longer have this inventory. It is gone. We shipped it, so we take it out of finished goods. Where do we put it? We finally expense it into cost of goods sold. Finally shows up on the income statement. So we're taking it out of the balance sheet, which is the asset, and moving it to the expense because we've sold it. So let's look and see what that's going to look like on our spreadsheet. All right, so we've completed it, and now we're going to sell it. So we would say something like sold medallions for $225,000. The cost of the medallions to make was $118,500. All right, so here we're going to put it on account, which means I need yet another account here. Accounts receivable, which is an asset, and it's going to go up for the $225,000, and that is revenue. So we're going to make our owner's equity go up in the account called sales. So sales is our revenue account. So here we earned revenue and we got an accounts receivable. Eventually they'll pay us cash, but for now we're going to hold it in accounts receivable until we get it. And then let's do the movement of inventory. And so we're going to take it out of finished goods, and we said that that was $118,500. And then we're going to finally move it to cost of goods sold. So we actually need a new account called cost of goods sold. And the cost of goods sold is going to increase, but we show it as a decrease to equity because that's how we have to show our expenses when we do it in the accounting equation. So we're going to put in minus $118,500. Let's see if we're in balance. If we add up all of our assets, we get 106,500, and if we add up all of our liabilities plus owner's equity or stockholders' equity, we also calculate it as 106,500. So we are in balance. So I'm just going to add my grid lines there. So that is how to account for a sale. Next, this slideshow wants to prepare a statement of cost of goods manufactured and a cost of goods sold and an income statement, which is great, but I want to show you first how to close out our cost of goods manufacturing. So I would not want to leave some extra manufacturing overhead. I need this account to be 0. So right now, manufacturing overhead, because this is not an account that would ever show up on a financial statement. Right now, manufacturing overhead has $33,000 in it. And that's just because we allocated based on a predetermined rate. So it was an estimate to begin with. But we don't want to leave it there. But I don't know what job it should go to. So we just assume, as long as it's immaterial, and we'll assume that this is immaterial for this company, that we close it to cost of goods sold. So when we close it, so we're going to say close over allocated manufacturing overhead. So when we close it to cost of goods sold. So we want to zero this out. So if I come down here to number 11, I'm trying to zero out manufacturing overhead. Right now it has a negative 33 in it. So I need to add back 33,000. And since I was over allocated, basically I'd taken out too much, then I need to put the other side to cost of goods sold. So it's going to be a positive 33,000. And so all that's going to do is reduce my cost of goods sold. And if I reduce my cost of goods sold, I'm actually adding it to net income. It's got a positive relationship to net income. It's a little confusing here because expenses are put in as a negative. So in order to reduce an expense, I have to put in a positive. So that's what I've done here. All right, so let's get and so we're in balance. We've got 33,000 on this side, $33,000 on that side. And so we'll get our new balances here. And my new balances equal, on the asset side, 314.5. On the liabilities plus stockholders' equity, 314.5. And what I've done now is I have nothing in manufacturing overhead because it's all been assigned to a job or just assumed that it got sold through cost of goods sold because it's been closed. All right, let's look at the schedule of cost of goods manufactured and the cost of goods sold and an income statement. So for the cost of goods manufactured, we have 3 types of costs. You already know this: direct materials, direct labor, and overhead. And so we're going to calculate the cost of raw materials and direct labor used, and then we're going to add up all the costs that were associated with everything during that period, and we're going to add those together to get our manufacturing costs. So it's going to look like this: raw materials inventory that we start with, plus anything that we purchased, gives you your raw materials available. And then you subtract out what you have left in your ending raw materials, and that tells you how much materials got used during the period. So this is a very common accounting calculation where if you know what you started with, what you added, and what you have at the end, then you can just back into how much got used up. And that's all we're doing there. Beginning plus what we add minus ending is how much we used up. All right, so that's going to tell you how much direct materials to put here. Then we're going to add direct labor. They usually just give you that number. Then they're going to tell you how much manufacturing overhead we have, and that gives you to your total manufacturing costs. Then we come over here and we say, okay, we got our total manufacturing costs. We actually had some at the beginning, so we're going to add in what we started with, the beginning work in process. And that's going to give us our total for the period. And then we subtract out our ending work in process, and that gets us to our cost of goods manufactured. All right, that's how to calculate cost of goods manufactured. Now let's talk about how to calculate cost of goods sold. First, think about which items you manufacture. So come back over here. You manufacture things that you're working on. So see how when we get to here, we're talking about work in process inventory, because you manufacture things that you're working on. Well, over here, we're talking about things that we sold. Well, which items do we sell? Well, we sell finished goods. So when we come over here, you're going to be starting with finished goods because that's what we sell. Okay, so we're going to have beginning finished goods plus the number we just calculated, cost of goods manufactured. That together tells you your cost of goods available for sale, so that's just a subtotal. Minus ending finished goods gives you cost of goods sold. So you see over and over again that we're doing that beginning plus what we add minus ending gives you the number we're looking for. So we're using that same formula all throughout here. All right, let's try a quick check. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw materials was purchased. Count at the end revealed $28,000 of raw materials. What is the cost of materials used? So we want to use that same formula. Beginning plus what we add minus our ending. So let's do it together. I'm going to pull up my calculator right here. I want you to pull up your calculator right there. Let's talk about how to do it. What is my beginning raw materials? 32,000. So start with 32,000 in your calculator. What did I add? Well, during the month I purchased 276. So say plus 276,000. And then what is my ending when I get finished? So you'll subtract that out. So it'll be minus 28,000. So we should get to $280,000. So let's look and see what it looks like on this slide with the answer showing. Beginning raw materials, 32, plus purchased, 276. That gives you a subtotal of 308 available, minus 28,000. So that gives you raw materials used of 280,000. Again, this is that calculation that we use over and over in accounting. When we know the beginning, what we added, and our ending, we can figure out how much we must have used. All right, let's look at quick check number 2. Direct materials used in production was 280. Direct labor was 375, and 180 of manufacturing overhead was added to production for the month. What were the total manufacturing costs incurred? We know that manufacturing costs incurred are direct materials, direct labor, and factory overhead. So we just need to add those 3 items together. So in your calculator, before we go to the next slide, go ahead and put in, or you can do it in your head if you'd rather, 280,000 plus 375,000 plus 180,000. So that's direct materials, direct labor, factory overhead, and I get 835. Let's go to the next slide and see if we're right. 835, and that's because manufacturing costs incurred are direct materials, direct labor, and factory overhead. All right, let's go to quick check number 3. Beginning work in process was 125. Manufacturing costs added to the production were 835. There were 200,000 of partially finished goods remaining in work in process. What was the cost of goods manufactured during the month? So for this one, we just put it into our formula. Beginning work in process inventory plus the manufacturing cost incurred. That gives you your total during the period, minus your ending gives you cost of goods manufactured. So again, using that same formula to figure out what we're looking for. Beginning plus what we added during the period minus ending gives you the cost of goods manufactured. All right, quick check number 4. Beginning finished goods inventory was 130. The cost of goods manufactured was 760. At the end, finished goods was 150. What was the cost of goods sold? We're going to do the same formula. Beginning plus cost of goods manufactured minus ending will give us our cost of goods sold. So let's go ahead and put in our calculator before we go to the next answer. So 130,000 plus 760,000 minus 150,000 gives you 740,000, and that is our answer. All right, next we're going to compute underapplied or overapplied. We did it on ours, but let's do it on another example called Pear Company. So Pear Company's actual overhead was $650 with a total of 170,000 direct labor hours. Their predetermined overhead rate is $4. So let's figure out how much to apply. So we're going to apply $4 times actual direct labor hours. So $4, and then what was our actual direct labor hours? 170,000. So we'll say $4 times 170,000. That's how much we're going to apply. When I say apply, that means that's how much I'm going to take out of manufacturing overhead and put into work in process. All right, so if actual was 650, and once I multiply that out, I get 680, then I have taken out too much. I only had 650, I took out 680, that left me with an over-applied amount. So what should we do? Well, we should close out the $30,000 and move it to cost of goods sold. All right, let's do a quick check to see how that works out for us. Tiger had actual of $1,210,000, and then they're going to apply out the rate times actual base, so the rate times actual machine hours. So 4 times 290,000, let's see what 4 times 290,000 is. 1,160,000. So we took out too little this time. We're only going to take out 1,160,000 when we apply it. So this time we are actually under applied. So the difference in the 1,210,000 and 1,160,000 means that I'm 50,000 under applied. And you can see it right here. All right, so what do I do with that under applied? Well, just like we did in our accounting equation, we can close it to cost of goods sold, and that's what we've done in ours. If the company chooses, they can proportionally close it to some other places, but we teach it in our books just to close it to cost of goods sold for now. So that's what we'll do. So we take it out of manufacturing overhead, and we put it into cost of goods sold. In this case, we're going back to that pear company one where we were over applied. So in this case, because we were over applied, we reduced cost of goods sold. And so we have reduced cost of goods sold right here by the $30,000. So in that example, since we were over applied and we reduced cost of goods sold, what will that do to operating income? Well, anytime you reduce an expense, it's a good thing, and your net operating income will increase. So over applied would increase your net income. And the opposite would be true if you had under applied. All right, that completes chapter 3. So let me know if you have any questions. Thanks.